Hello and welcome. You're watching Earnings Central with me, Ashmit Kumar. Of course, the big numbers we're tracking, SBI expected over the weekend. We're getting more color on that. In fact, just the numbers that we're beginning to see now, there seems to be a beat of the expectations, both on the standalone net profit front as well as on the net interest income front. We understand that as far as the expectation is that there will be a cut of about 12 to 15% YOY when it comes to standalone net profit. However, it's come in at about 18,643 crores. You can see it on your monitors there. Net interest income as well coming in at 42,774 crores, slightly higher than the expectations of the market of the CNBC-TV18 poll. In fact, to dive straight into these SBI numbers, to give us more color on what exactly these numbers translate into, let's go across to my colleague Abhishek Kothari, who's joining us live from the Mumbai studio. Abhishek, take it away. Tell us, what do these numbers mean, especially a beat on the big two numbers that the street had been watching for?
Well, Ashmit, you are right. It's a beat with respect to our NII and PAT. The PAT beat is largely led by other income. Other income has jumped up to 24,210 crore versus 11,041 crore. That's about 2.2 times the jump that you are seeing in other income. The NII is a beat with respect to the cost of funds actually coming down. So they have had a deposit growth of 2.9%, but interest income growth is only 1.2%. In front of that, if you take a look at the yield front, they have lost out on yield, 4% sequential growth in advances, but only 1.9% growth in the interest income over here. So overall, the NII, thanks to cost of funds remaining under control, that's a beat over there. Other income, substantial jump over there. They have made provisions for NPF, which has jumped up by 72% quarter on quarter, and despite that, the asset quality has improved. So it looks like there might have been high write-offs in this quarter, for which they might have made provisions, because asset quality is one of the best that you are seeing in last 10 years, coming in at 1.82% gross NPA ratio versus 2.07% gross NPA ratio in the previous quarter. In absolute value, gross NPA is down nearly 9% quarter on quarter, net NPA is down 8% quarter on quarter. So we can see that there has been sharp improvement in asset quality, and that might be led by the fact that there might have been write-off because provisions for NPA have spiked up. Talking about the business momentum, our deposit growth is in line with our expectation, 9.5% YOY growth and 2.9% sequential growth. However, the advances growth has come in slightly below our expectations. So 12.4% YOY growth and 4% sequential growth coming in for SBI. So overall, a good set of P&L numbers. Business momentum slightly below our expectation, but no worries, taking away from the fact that operationally it's been a strong quarter for them. Back to you.
Right, Abhishek, thanks so much for that. In fact, do stay on, Abhishek. We'll come back to you. We'll discuss the Kotak numbers as well in just a moment. But before we do that, let's go across to Ashutosh Mishra, bank analyst at Ashika Stock Broking. Ashutosh, thank you so much for joining us. What do you make of these numbers? A beat on the expectations, higher than what the street thought that the SBI will clock this quarter.
Yes, so number is a beat and mainly led by the other income, which is one of the important parameters. Even on asset quality and business growth, although is slightly below our expectation out there, but it is given the liquidity condition and SBI being the largest bank, this is also expected out of it. And the way RBI is now easing the liquidity clearly look like that FY26 can be the very good year for SBI from that perspective.
Ashutosh, if you take a look, as I mentioned and you have mentioned, that other income has led to a beat. Now, just to make our viewers understand, the asset quality has improved, but provisions for NPA have increased. So it looks like, on the first print that there might have been higher write-offs in this quarter that led to improvement in asset quality?
Yes, there can be the cases where they may have written off part of their assets, and along with that, they increase the provision to maintain the provision coverage ratio. They may have increased the provision in the P&L part of it. But it's okay even if you. After taking that also, credit cost is well below the industry level. So that is, in my view, is not the concerning part of it. If the bank is earning some extra profit, they can really make extra provisioning at this point of time so that they can use it in a future period.
I'll just have to come in there, Ashutosh. Thanks so much for joining. Do stay with us.